Hello, trading friends, and welcome back to Forex Focus, brought to you by IG. Taking a look at the Canadian dollar, Bank of Canada's recent decision, and a little bit of crude oil price action for today's show, as all of these markets and stories are aligning to push this Canadian dollar a little bit further in the upward trajectory. And let's start with that price action, because it's been a nice big rally here for Canadian dollar, looking at it against USD. And you can see this market went from close to 136 prior to the Bank of Canada meeting, and then falling all the way down close to 135. US dollar did, Canadian dollar appreciating after this Bank of Canada meeting. And the Bank of Canada came out and decided to hold interest rates unchanged at 5%. And there's a couple of things to take from this. One, they weren't expected to cut rates, but they held them firm and gave a little bit of a hawkish tone that they're not necessarily inclined to be maybe the first major global economy to be cutting interest rates, as that seems to be the common theme and story that is permeating Canada, US, Euro area, UK, and Japan. But two, keep in mind that 5% interest rate in Canada, that is relatively strong compared to the Euro area, compared to Australia, compared to Japan, obviously, as that's really a top three interest rate in terms of strength, right there with the U.S. at 5.25% to 5.5%, the UK around 5.25%, and then Canada right there at 5%. And so, no real surprise to see that the Canadian dollar seeing some strength after they hold, because the line of thinking might be, well, they hiked pretty far, and so they have plenty of room to cut if they do want to be the first major economy to have their central bank cutting here. But it's not going to happen in March, and they're at least giving some confidence that they will not lower their rates, at least in the near future. Of course, anything can happen, but for the time being, holding strong at 5%. And a lot of this ties into what the inflation story is in a given economy. And Canada's inflation is actually comparatively pretty under control at 2.9%, not really breaking out far beyond 3% the last several months here. And so I think this is maybe why people, some traders, thought that this Canadian central bank meeting could be one of the first to signify that a cut was coming, relative to the ECB or the Bank of England or the U.S. Fed. Because their inflation is pretty under control. But again, 3% is not that 2%. You've heard it in the U.S. They're looking for that 2% target. And even if it is 2.9% or 3.1%, they're wanting to see it get a little bit lower before they finally cut rates. Because of course, the scenario that they don't want is it's 3%. They start to cut rates down by 50 basis points, 100 basis points, what have you, and inflation rears its ugly head again. And Canadian inflation got as high as 8% in the U.S. By some metrics, it was 8 or 9% for a month or two. And they don't want it to climb back up there and, we cut, and now we have to hike again to try to get this inflation under control. Want to make sure that it gets down to that 2% target. And so no cut here out of Canada. Another piece that could be helping to lift this Canadian dollar is the developing story in crude oil. Recently here, intraday hitting $80 a barrel. It's been quite volatile, trading back and forth. But in the last handful of trading days here, trading around year-to-date highs for 2024 and trading around that 80 handle for the first time really since October, November of 2023. And we haven't seen triple-digit crude for a while, but we have seen some of these runs beyond $80, up to $90 a barrel. And you might recall that the Canadian economy lends a lot of its GDP and its broad economy to the energy industry. And so historically, there has been a correlation between crude oil prices and Canadian dollar strength and weakness. And you might say in recent trade, it looks like this US dollar is a lot more tied to crude oil than Canadian dollar is. But these correlations can break down and get wonky for short-term periods. And they've definitely been, probably no coincidence that the U.S. is starting to produce more and more crude oil as a proportion of the global production. And U.S. dollar is starting to get a little bit more correlated to crude oil. But if you look back as recently as, September, October of last year, you see that crude oil market, when it got beyond $80, $90 a barrel, U.S. dollar, Canadian dollar was moving lower in that same period. You see that mirror image of the spike in the black line there in September, October, the middle of this chart, and the move lower in dollar CAD. And you see some other similar instances there of them moving inversely, but especially on that last time that crude oil ripped beyond $80, $90 a barrel, seeing some Canadian dollar strength at that period. And so the correlation to crude oil as well as a firm Bank of Canada could lend this Canadian dollar to some further strength, could put some wind behind the sales of this Canadian dollar that's been really stuck in this 134 to 136 range, but now gaining some steam to the upside for a Canadian dollar. Dollar USD CAD obviously moving to the downside. We'll see if 135 holds or if they can challenge that 134, get as low as where they've been in the last year. The lows have been 131, 132 range. Now, of course, the flip side of this, crude oil could give back some ground, and the Bank of Canada, maybe the next inflation print is closer to 2%, and they do start to cut interest rates faster than the U.S. A lot on the table, but for the time being, seeing some crude oil strength, some hawkishness out of the Bank of Canada, and seeing this Canadian dollar start to turn to the upside.